For most of 2023, the residential real estate market has been more resilient than expected, or at least I should say it's more resilient than I expected it to be. This summer has been particularly hot, and we've seen housing prices actually go up year over year. But the summer is coming to an end, and we are heading into the fall where we normally start to see seasonal declines. And this year in particular, there are a confluence of different factors that could slow down the market and send it back into a correction like the one we saw last winter. So in this video, we're going to review the most recent housing market data to make sure you understand exactly where the market stands today and what to expect over the next couple of months. And we're going to discuss my 4 key things that you need to watch as we enter the fourth quarter of 2023. Before we get into today's video, I just want to talk about something really important. Whether you're flipping houses or buying rentals, every investor needs a simple, reliable, and fast way to access financing. And no one wants to go asking their family or their friends for a loan. Instead, you can turn to Kiavi. With Kiavi, you can access high leverage and flexible loan options like bridge loans or DSCR loans and rental portfolio loans. Over 12,000 real estate investors currently choose Kiavi as their go-to funding partner. And with Kiavi's online platform, you can get approved quickly. You can download pre-qualification letters and track your loan status 24/7. So visit Kiavi.com, that's KIAVI.com/BiggerPockets to see your rate today. That's Kiavi.com/BiggerPockets. Terms and conditions apply. Please see Kiavi.com for further details about potential loan options. NMLS ID 1125207. All right, let's talk about what's going on in the housing market this year. As we enter the fall, housing prices are, I find, kind of shockingly flat or slightly up for the year. And in this video, I'm going to be using a bunch of different data from Redfin. And it depends on who you ask where housing prices sit. Redfin, as you can see on this graph, currently has it at 1.6% up year over year. That's not crazy high, but given everything that's going on and all the headwinds that are facing the market, it is really notable that housing prices are up year over year. Some sources, I should say, have it closer to flat. But either way, prices are relatively stable relative to the predictions that a lot of people were saying that we were going to see a bigger market correction or possibly even a crash. And there was a correction over the winter. If you look at this data, you can see that housing prices were negative year over year, starting, I think it was back in about December or January of 23, and continued through much of this year. And just over the last couple of months during the summer, we have seen prices go up. So this is somewhat surprising that prices have stayed this high. And when you combine that with interest rates, or mortgage rates, I should say, that are now well above 7%, this has deteriorated affordability to levels we haven't seen in decades. And this is a really important fundamental of the housing market that everyone should really understand, because I think personally, affordability is going to play a big role in which way the housing market goes over sort of a longer term, the next 2 to 5 years, let's say. So if you look at this chart, you can see that during most of the last several years, housing affordability has been really high, and that has really bolstered growth in the housing market. Now, when we see what's happened over the last couple of months, that has fallen really dramatically down to really the lowest level that we have seen since the mid-80s, and that is obviously going to have impacts on the housing market. The most notable impact here is, of course, that it's pulling demand away. When affordability declines, even if people want to buy a home, they can't afford it, and that reduces demand. And I think that's important to know, is that when you talk about supply and demand in economics, demand is not just who wants to buy something, it's who wants to buy it and can actually afford to buy it. And so even though there are probably likely many people who still would like to buy a home right now, because affordability is so low, again, due to really high prices that haven't fallen that much and still rising mortgage rates, demand and affordability have declined. It is worth mentioning now that what I'm talking about here in the housing market is really on a national basis. And of course, there are many regional differences to what is going on in individual markets. And I just want to share one example because I found this kind of interesting. I found this article the other day by Adam Data, great data source, by the way, that had showed that several markets in the US are actually seeing demand increase, even though mortgage rates are going up. I'll show you quickly some of these markets. It's Knoxville, Tennessee, Honolulu, Madison, Wisconsin, Ann Arbor, Michigan. We have upstate New York, Utica, and Rome. Then we have Alabama, Daphne. I've never even heard of that place, but sounds like an interesting place where people want to live. We have Manchester and Nashua, New Hampshire, even expensive parts of California like San Jose, Sioux Falls, but none of them come close to the Boston metro area, which has seen more than 60% quarter over quarter demand growth, according to Adam. So like I'm saying, higher interest rates have pulled demand out of the market on this aggregate national level, but there are obviously places where demand is going up. But I digress. I just wanted to share that with you because I found it interesting. But let's get back to sort of the broad national trends. We said that demand is falling nationally, and that usually means that prices are going to fall, right? That is one of the tenets of supply and demand, is that demand, if supply stays constant, prices will fall. But supply has not stayed constant. Supply is also down. So if you look at this chart again from Redfin, you can see that during the pandemic, supply got really low. We all know this. Then during that brief correction that we were talking about, it went back up and outpaced supply, which is why we saw prices drop. But now they have dropped back down. And actually, as of July, inventory is now about where it was back in 2021 when the market was going crazy. And it is well below where it was in July in 2022. So this is due to a confluence of reasons, mostly the lock-in effect, which is basically people don't want to move right now. They don't want to put their house on the market because it's too expensive to move. People are still staying in their houses longer. And so there's just lower supply. And when these two things happen together, when demand drops and supply drops at the same time, if it happens in a relatively proportionate way, prices can stay relatively flat. And that is exactly where we sit today. Volume is down, but prices have stayed relatively flat. Now that's, again, just a point in time. And of course, this can and will all change. And I think as we head into the fall, there are some major questions about what is going on in the residential market and can it retain its strength? So to me, these are the 4 questions that I'm going to be thinking about, and I recommend you keep an eye on as we head into the 4th quarter of 2023. The first question, of course, is about the Fed. Will the Fed pause interest rate hikes and, perhaps even more importantly, provide a clear path for monetary policy? We all know the Fed has been raising rates like crazy since March of 2022, and they have been deliberately ambiguous about what they're going to do next. But as they come probably to the end of this tightening cycle, providing clear guidance about what they intend to do for the rest of the year and into 2024 could help ease some economic uncertainty. Doesn't mean it's going to make the economy better all of a sudden, but it can at least provide some clarity and allow investors and just normal people to start making more confident decisions about what to do with their money, which is hopefully a first step in improving the general economic environment. So that's the first question. The second question, which sort of feeds off of that, is will mortgage rates climb even higher than they are today? The Fed controls the federal funds rate, but they don't control mortgage rates. That is more dictated by the yield on treasuries, which is impacted by all sorts of things. It is impacted by the Fed policy, but it is also influenced by a whole bunch of other things. We're not going to get into all those things here today, but the question is, will mortgage rates climb? As of this recording, the average 30-year fixed rate mortgage is about 7.25%. And to me, this is the big thing about affordability. And affordability is basically comprised of 3 things, right? It's home prices, it's wage growth, like how much people are making, and it's mortgage rates. And personally, because prices have stayed relatively stable, I don't think even if they come down a little bit, which they might, that they would make a huge impact on the affordability of homes. Wages are going up slightly, just slightly more than inflation. And so that small difference is really not going to change affordability. So if affordability is going to change in the coming months, it's going to be about mortgage rates. So that's why I think this is obviously something important to watch. Third question. Will student loan payment resumptions, which start October 1st for the first time in about 3 years, will that pull even more demand out of the market? Remember the chart I showed you before that demand is just evaporating from the market? Will this resumption cause even further demand declines. There has been some studies that show that the average student loan payment is going to be about $400 per month, which is really significant. And that might take people who are on the fence of being able to buy a home and pull them out of the market altogether. So that's the third thing I'm going to watch. The fourth thing is, will the labor market decline in any significant way? We have seen a surprisingly resilient labor market, and there are many ways to look at the labor market. No data is perfect, but if you look at the whole picture, it does show relative strength. That happens if you look at people who are working 2 jobs versus 1 job. When you look at the labor force participation rate, if you look at all these different things, it does show a relatively resilient housing market. But there are signs that is beginning to slow down. We've seen much cooler hiring numbers. We've seen initial jobless claims start to tick up a little bit. And so the question is, will the aggregate effect of all of these interest rate hikes that we've seen over the last 18 months or so finally impact the labor market in a significant way? And what will that do to the economy? So that's the fourth question. Will the labor market decline in any significant way? I have some theories, but I think we really just don't know, and we're going to have to keep a close eye on all of these things as we go through the rest of this year. I will, of course, update you on everything that comes out, all the economic news, all the data, if you subscribe to this channel. So if you don't already, make sure to subscribe. My name is Dave Meyer. I'm here for BiggerPockets, and I will see you again next week.